Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we got some breaking news about interest rates and how it affects your investments out here. As you all may know, rates have dropped.
Yes, they have.
We're going to talk about why, but more importantly, we're going to talk about how that changes the outlook of investing in rental properties for you. I'm your host, Pablo Gonzalez. With me right now, the man is the man I like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It's good to be back, man.
It's good to be
back here.
Hey, did I set up the mic the right way today?
I don't know.
You haven't corrected me yet here. I feel pretty good about it.
Once you start, yeah, I was thinking about that too. And I want to welcome the community. Thanks for checking in here. We are still buzzing from the fan appreciation show on Tuesday. That was such like a vibes. It was so good. It was so good. It makes me really look forward to our Not Your Average Investor Summit that we are continuing to improve even as it gets closer in a bunch of meetings in the last 2 days about how we make it special, how we surprise you, how we make it so that you're going to want to tell all your friends forever about this thing because it's so cool. And that is on February 16th and 17th here in Jacksonville, Florida. We already have over 40 people registered. I think we're like 44, 45 right now.
Yes, we are.
So tickets are flying fast because only right now we're advertising to the podcast and to you, the community right now. So we haven't even started pushing these things. So if you want your ticket, if you want to join us for 2 days of education, for 2 days of like eye-opening experiences, and more than anything for 2 days of connection with the rest of the Not Your Average Investor Show community, go to jwbsummit.com. That's summit with 2 M's and 1 T. I messed that up before.
Yes, you have.
jwbsummit.com. And
I'm gonna see if you're gonna talk to him about the promo code, the special promo code. Remember we have a promo code?
I leave that to you, but I feel like I did the whole read except for your part.
I know, and I'm probably gonna need some help from Cody. Cody is our amazing community manager, and Cody, I need some help with that special promo code that we have because I already forgot it. But basically, the tickets. She laughing at me? Yeah, so we want you to come to this event. Let me tell you a couple of things as well as we rattle off that promo code in just a second here, guys. I want to share with you a great investment opportunity that you may not know is there. And I want to share why it's such a great investment opportunity. We're not just talking about single family rental properties, which is our bread and butter, and that's our investment that we sell. But we're talking about that great investment coupled with the opportunity for significant upside. And if you look at some of the markets that have performed the best over the last 10 years, I'll rattle off a few: Denver, Austin, Nashville. Okay. Those markets all have one thing in common.
What's that, Greg?
That they had a downtown that became revitalized, grew, and then significantly increased home price appreciation and rent rates in the single family rental properties that were surrounding those downtowns. And it actually, over the last 10 years, they've experienced 23% more home price appreciation, those three markets, than the national average. And there's many more examples as well. So your question should be, why did that happen? Well, if it's the downtown that really contributed to that, what's the next downtown that's about to pop? And that next downtown that's about to pop is Jacksonville, Florida. And there is over $4 billion of active construction going on in downtown right now. Many people don't know it, though. Not all of those buildings have come to fruition yet. Takes a little bit of time for that. But $4 billion.
The average investor doesn't know. The average.
There you go. What the average investor doesn't already know is that even before those $4 billion of construction hit, Jacksonville's downtown population has increased 60% in the last 5 years. That's before all of this. So if you can kind of connect the dots here, we talk about investing in a solid asset class that has upside. The greatest opportunity for upside that we see over the next 5 to 10 years is owning single family rental properties surrounding downtown Jacksonville. And so if you think this is interesting, you will want to come to our summit as well. We're going to be doing a tour of downtown Jacksonville. And JWB puts our money where our mouth is. We've invested $68 million in downtown Jacksonville. So we're going to get to see all of these wonderful projects that we are a part of, that we have contributed, and that are many of them are actually completed now. So you're going to get to walk through them.
And you're going to meet in person past guests of the show that are pushing the scales on these projects. Right? We're not going to tell you who, but there's some pretty big names that are going to be there. So I think it's going to be great. that code. If you want to go to jwbsummit.com, put in the code NYAIS for like Not Your Average Investor Show, NYAIS 99, and you'll get the right price.
You do, because it's $139 on the website. But if you put the promo code in, that drops that to $99 for your tickets for this wonderful experience. So we can't wait to see you.
Glenn Friedman says jwbsummit.com is not working. So I am checking it right now.
Oh, yeah?
Yeah.
Well,
Cody will check that out.
We'll figure it out.
We'll figure it out.
Hopefully it's working.
So
It was working when I checked.
It was working when I checked too. All right. So jwbsummit.com, NYAIS 99. And you get to put a face to the name of some people that we're about to do and what, GC?
The roll call, baby.
Baby. We got Right Along Raj, who I met at the last meetup, or maybe the one before that.
Be there on the
Who
next
will
one.
also be there to ride along. We got the early bird, who was actually the first person to buy his ticket.
Of course, Mr. Dean Curry.
Mr. Dean Curry. We got our leadoff hitter, John Henning.
All right, John. Is John coming?
I don't know if I've seen John on the list, but I did see John type lower below that he's shooting for being in the top 5 most attended attendees, like we did
That was a cool list.
That was a cool list. We got the patron Santorios of the Not Your Average Investor.
Michael Santorios.
We got the Shaman.
Nadeem Shah.
We got Big Papa in the house. We love it when he calls it Big Papa.
Pops, how are you, my friend?
Gregg Cohen, Greg's dad. Who else? We got Mark Norman is back, wishing us a good morning, happy New Year. Good to have you. We got the man that everybody knows from California.
Noah Rendari, who came last year and brought his family. I remember.
Family, man. I remember that. That was cool. We got Cody Adams, our mama bear, in the house.
Makes it all work.
Vincent Barbarites?
Absolutely.
Yeah, I feel like I've already messed that before.
I think you messed up every time.
I've messed that
That's
up.
how he shows love, by the way.
It's my love language. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline.
We salute you.
We got Laura Colby in the house from Washington State. Welcome back.
All right, Laura.
Laura, good to have you in here. We got Scott Richardson joining us for the second time.
All right.
Scott, what brought you back, man?
I love that.
I love it, Scott. Good to have you here, man. Let us know in the chat. Who else? We got Alaska Atiza.
Ooh, fantastic.
That is an awesome name.
I agree.
Yeah. Okay.
Well, you got to keep coming back, Alaska.
Keep coming back, Alaska. Good to have you in the house. No, it feels a little chilly in here. All right. Who else we got? Oh, we got the MVP in the house.
Mr. Lee Bishop.
Mr. Lee Bishop, as you
You
are.
know who you just scrolled over there?
Who did I scroll over with? I'm not. Oh, the Mountain Man.
Mr. Billy Green.
Mr. Billy Green from the propitiously pale mountains of Colorado. Bill, you're really making it tough on me, buddy. All right. He's like a former radio personality. He's just testing my chops over here, and I'm failing. Who else we got? Oh, we got the fairy godmother of the Not Your Average Investor.
Jen Filson, none other.
Jen Filson, who will be joining us as well. I feel like a lot of these names that we've been saying are joining us as we know. The Maven from the mountains of Denver, who's also bought our ticket too.
Ms. Leslie Wilson.
Jeff Petty John is back in the house. Jeff,
All right,
good to
Jeff.
have you back. And the mystery man, the number one attendee of the year is here.
There he is. His reputation precedes him, Mr. Denny Davies.
Mr. Denny Davies, star of the show. And of course, local real estate legend here, community builder, Glenn Friedman.
There we are, Glenn.
Who's also coming.
I saw that, Glenn.
Yeah.
We're so excited to have you, bud.
Good to have you. Oh, Marty from Golden, Colorado. I love the Colorado contingency is growing. John Moran from Port St. Lucie. Good to have you. Misty Johnson, another top 10 in the house.
Absolutely.
Good to have you. Feliz jueves, amigos. Bill Shields.
Clearly.
Eddie Harris from Atlanta. This is
What a great roll call. You guys like interest rates dropping. Who doesn't like interest
Who would have
rates
known?
dropping?
My buddy Bob Wiesner's back for the first time. I haven't seen him in a while. So from Marietta. Man, this is great. Eric Killo from Southern Minnesota.
Minnesota.
MN Minnesota or Montana? MN is Minnesota.
I'm going to go with it.
Eric, good to have you, man.
Not a geography check.
I was born in South America. Okay. All right, here we go. GC. So now I just got to gather myself if you'll bear with me. Interest rates dropping. I haven't heard any news about it. Is Minnesota. Cool. I haven't heard any news about the Fed. But interest rates have dropped. Give a little explanation of what's going on.
Well, so many people think that the Fed controls long-term interest rates and the interest rates on the mortgages that we get to buy our investment properties. But the Fed does not control interest rate. What the Fed controls is called the Fed funds rate, and that indirectly affects long-term interest rates. And case in point, the last 2 months. If we go back a couple of months, The average interest rate according for the 30-year fixed rate mortgage, according to Freddie Mac, was 7.79%. But guess what? The new year brings good things, because if you look at the average interest rate for a 30-year fixed rate mortgage, according to Freddie Mac, today it comes in at 6.61. Did we say sixes?
We said
sixes. Okay, so we've dropped. Mortgage interest rates have dropped on average about 1.2%, which means a lot to us as investors. But guess what hasn't changed?
What hasn't changed?
The Fed funds rate. So the Fed has actually not decreased the Fed's funds rate. So this is a great time, because when interest rates drop, that makes our returns on investment higher. That same asset, lower interest rate, increases the return on investment. We're going to do a little deep dive into that today. But it's also a great learning moment to see that this can happen, that this indirect relationship is real, and that you can actually have long-term interest rates come down even if the Fed funds rate stays constant. Because then you can start to think about, well, what actually would happen to long-term interest rates if the Fed funds rate, and when the Fed funds rate actually does come down, right? We can start to think of a world where interest rates are actually lower than 6.61%, but you don't necessarily have to wait for the Fed to take that action in order to make it happen.
Okay. All right. So that is why interest rates are dipping. And what GC has done is put together a little informational presentation here so that you see the big difference of how it affects cash flows, returns on investment, your lifestyle, all that good stuff. But first, we start with a little advice.
We should.
Yeah,
we should. And you should do your own due diligence when you are thinking about making an investment. Do your own due diligence. We're here, we're having fun, we're providing education, and all the data that I put in front of you is based on historical data and assumptions, but you know what? Those are estimates. It's not guaranteed. So do your own due diligence, do yourself a favor, and make sure that you keep attending this show and keep listening, but also don't stop there. Go a little bit farther before you put your own money into work.
Sounds good. All right, JC. Let's, what's going on here?
Yeah, so here's just in graph form, pulled straight off the Freddie Mac website. This shows either the 30-year fixed rate mortgage or the 15-year fixed rate mortgage. We'll focus on the 30-year because that's most often what's quoted. But you can kind of see what interest rates have done over the last, year and a half? My eyesight's, a little it's not as good as I'm 41 now as it was when I was
you're a young man.
40. But yeah, over the last year and a half, you can see that interest rates have gone way up.
Yep.
We got close to that dreaded 8% figure out there. And, since then, you've probably read a lot of articles. You've probably heard a lot of talking heads talking about how the question is not how much more is the Fed going to raise rates. The question is now, is the Fed done raising rates? And when is the Fed going to start lowering rates? And when the economy, the investment population believes that the Fed rate hikes are at an end, what they start to do is to create more demand for investments like mortgage-backed securities. And a mortgage-backed security is just a fancy term for the mortgages that we pay interest on. The investor on the other side receives that interest rate. So there are investors on the other side who make a decision, is it something they want to lend their money out and invest in that investment. So when the Fed says, hey, listen, we're probably done raising interest rates, which is a lot of what they're signaling now, the opportunity for an investor to lock in a high, what they perceive to be the highest mortgage-backed security return on investment is there. And so you see a lot more demand for the back-end investors of these mortgage-backed securities to come in, buy that asset, invest in that asset. And ultimately what that does is it drops your interest rates because there's more demand on the back end, which we don't normally think about. And so ultimately that's the biggest movement here. And that's what you're seeing. That is in essence why long-term interest rates have been dropping, even though the Fed hasn't changed anything yet. There's more demand for that investment.
Got it. So what I'm seeing here, GC, is, and what I'm taking away from your conversation is this is a graph that has been trending upwards, right? It's got its little peaks and its little valleys, but it's mostly an upward trending graph. And it feels like it has hit its high And now this is blipping down. It might blip back up again, maybe a little bit, but we believe that in the near future, this thing's going to start trending down again to a certain extent.
I won't go that far.
Okay, you're not gonna go that far.
Well,
right now, it's
the
down.
world's a crazy place right now.
Okay.
So I don't know exactly what interest rates are going to do from this point forward, but I know this is really positive when it comes to your decision to buy your next investment property.
Right now.
Right now.
Yeah, right now.
And I think long term, you're going to see rates come down. I just don't know what that path looks like.
Cool. Sounds good. So that's what mortgage rates are doing. They just blip down right now. We like to pay attention to mortgage rates because mortgage rates affect the demand side of the equation, right? Like the lower the mortgage rate, the more people are in the market are more likely to buy a new house, invest in a rental property, things of that sort. Supply stays constant. Supply is still an issue because there is too little supply, which is what's kept the prices high, and they haven't dropped, even though we've had historical lower demand.
I won't say historical lower demand, but historically high interest rates.
Historically high interest rates would spook everybody, right? But the prices have stayed high. But what we're saying now is demand is now going to increase with the same amount of supply that is still constant, which we talk a lot on the show about supply and demand. And, generally, if supply is constant and demand goes up, prices will go up. So we believe that that's kind of the dynamic that's happening in the market. But more importantly, let's talk about how this new mortgage rate affects the investment.
Yeah. So, and if you have been listening into the show for these last 2 months, it's been a fun journey. When we did our quarterly real estate market update, I shared an update of what JWB would estimate the interest rate to be on a property evaluation for one that you're investing with JWB based on what the market is performing at as far as an interest rate. And originally, 2 months ago, that was at 6.75% interest rate. Now, that was a lot lower than 8%, which is what the general public was getting at that time. And because of our relationships with our lenders and because of the incentives that JWB was offering and still is offering, we were able to get an interest rate at 6.75% at that time. But that was 2 months ago.
Yeah.
Now, overall, as interest rates come down, what I wanted to show everybody here is how much more profitable does it make that same exact property that you're buying at a lower interest rate? Make sense?
Makes a lot of sense to me, man.
Cool.
Yeah.
Well, good stuff. So let's start with what that property, one of a JWB investment property, how much profit would that contribute over the 5 profit centers? And this is built on the expectation that you're a buy and hold investor. So this is a typical purchase price. This is a 30-year fixed rate mortgage. And this is assuming that you're holding on for 20 years. That's what all of these numbers are based off of. And at that 6.75% interest rate, we can go through the line items here, but you start to see some pretty high numbers here. Is this still a good deal at 6.75%?
Looks better than what other things I've seen. Yeah.
Over 20 years, the total profits earned are over $429,000 estimated based on historical assumption, things that have already happened in Jacksonville and based on JWB's management of the asset for you. And that equates to an 8.9% internal rate of return. That's your return on investment each and every year that you're investing there. So over $53,000 in net rental income, over $10,000 in tax savings, over $62,000 in principal pay down, and over $303,000 in home price appreciation. So those are those profit centers that all combine to create the big picture about why you're investing in this asset. And the cool thing is that this asset wins at 6.75%.
Yeah.
Imagine what happens when that interest rate drops.
You don't have to imagine because we're going to make the numbers real. What we have learned on this show is that we can talk about all these lofty concepts, and we tend to talk about concepts for like 1 to 2 to 3 months at a time. And then finally it actually happens. And then we can actually show it, right? So now we're going to show the difference between this investment, which looks pretty good, to an investment with a 0.5% drop in interest rates, 6.25%.
Exactly. Again, same asset, same purchase price, same 30-year loan, same hold period of 20 years, all of those same metrics there. The one difference is your interest rate 6.25% instead of 6.75%. Well, what that does from a net rental income perspective, it takes it from about $53,000 to about $64,000. So just simply by that interest rate, over a period of 20 years, right? That's $11,000 more in your pocket because the because the long-term interest rates came down. Tax savings go up as well. Your principal pay down goes up as well because you have less interest that you're paying on your mortgages. Home price appreciation doesn't go up. Why doesn't that go up?
Because home price appreciates based on the market.
Right, exactly.
Yeah.
But what you could make an argument for is that we know overall when interest rates go down, that increases demand for the asset. That's why if you look over history, you see periods where interest rates declined 1% or even more, you see substantially higher home price appreciation the following year. That's why on this show, I'm telling you, you want to be buying before interest rates go down as low as they're going to go, because you're going to see home prices go up.
Yeah, you're going to capture that appreciation of the asset. You could also argue that if downtown happens, then that home price appreciation rate is going to bend, and
it's all about demand.
Go a lot faster. It's going to create more demand.
Exactly. Yeah. Downtown is a huge catalyst for demand. Just like interest rates going down is a huge catalyst for demand.
Got it.
But we didn't include that effect in these numbers here. I just assumed that home prices appreciated the same rate, but still over $300,000 there. So
simply put, 0.5% drop in interest rate creates 11,000 more in rental income for the year. 11,000 more in rental income over the 20 years. Right. About 1,000 more in tax savings, about 3,000 more in principal pay down, and then same home price appreciation, and it creates a 0.4% better return over 20 years.
Yeah, absolutely. All in all, it's about a $15,000 net positive just simply by investing in an asset at a 6.25% interest rate rather than 6.75.
I like that. But GC, what if it drops even more?
Well, the interest rates that a lot of folks are seeing right now is 5.75%.
Okay.
And so on our estimates for our pro formas, our evaluations, you'll see 5.75%, which, man, when you get in the fives, sounds so much better than the sixes, right?
So much better.
And sixes sound so much better than the sevens, right?
5-minute ads,
There we go. 5 hour energy. Yeah. I mean, there's something to this.
Yeah, something to it.
Well, you're going to see a similar effect here, right? Now, instead of $53,000 of net rental income over a 20-year period. Now at a 5.75% interest rate, that number is now over $75,000. Tax saving goes up as well. It's now over $12,000 of tax savings. Principal pay down is over $67,000 of principal pay down. And home price appreciation, again, this is probably an under promise and over deliver moment here. We're going to keep that, stagnant, saying it's going to appreciate at the same. But all in all, you'd bumped up another roughly $15,000 in total profits simply by going from 6.25 down to 5.75 for the interest rate when you acquire.
Which leads us to a grand total of 2 months ago. It was at we were seeing this happen at 6.75%. Now we're seeing this happen at 5.75%. And the difference of investing right now under these conditions are an extra $12,000 in net rental income, an extra $2,000 in tax savings, an extra $5,000 in principal pay down, and an extra 0.8% IRR over that 20 years. Pretty impressive, man.
But what about those folks that bought properties like I advocated for them to do at a 6.75% interest rate? Pablo, are they screwed?
No, I believe that the people that bought that 6.75% interest rate are going to hold on to that a little while longer, or up until that once the rate makes sense to refinance and they can cash out some of that equity, lock in that lower rate, because as I have learned, thanks to this community, you marry the asset and you date the rate.
Such a good little slogan there. I love that.
Who said that to us? Was it like Sarah or something? I think Sarah.
I don't know. It's been vernacular for a lot of folks in the mortgage industry for a long time. It makes so much sense when you're making the investment decision.
Makes a lot of sense to me too, man. This is getting very real. So this whole idea of, first of all, didn't you just show me a chart that said rates are in the it's at 6.61%. What's up with this 5.75%?
Yeah. So here's the other reason why I really want you to consider adding to your portfolio right now is as interest rates have gone haywire over the last year and a half, JWB stepped in to offer an incentive for everybody to help get that interest rate down as low as possible. That's not something we had ever done in our company history before, but these were not normal times when it came to interest rates. And so JWB offers a concession, which helps our clients' interest rate get bought down. And it comes out to roughly about a $5,000 incentive that JWB contributes to the client. And that can either be a cash receipt of $5,000, or the client can decide to use that to get their interest rate as low as possible. But we're only doing that because interest rates have been so high. I've been sharing with you all that it won't always be that way. As interest rates continue to come down, we're actively considering, when are we going to stop that incentive? Because that's not normal for us. So we are continuing to offer the incentive right now, even though the interest rates that we're seeing for our clients are at 5.75%. So another reason for you to think about taking action and starting to add to your portfolio right now, not only do you get to, of course, see more profits just because of the lower interest rate when it comes to cash flows and things of that nature, you also have the opportunity to get in before interest rates drop lower, which we see over the course of history leads to getting in before home prices appreciate more. But you also have this incentive from JWB still. And so if anybody is considering adding to their portfolio, this is a great time. If you're a current client, reach out to your JWB portfolio manager. If you're not a client yet, start up the conversations with us. You can go to chatwithjwb.com and set up your own appointment, or you can just send an email to info@jwbcompanies.com. And we would love to chat with you, because I do think this is a really special moment.
Yeah. I mean, this, if you've been following along the show and paying attention to what I say and not just what Gregg says, which I don't blame you, is, I just recently bought my own primary residence. I'm buying like a duplex where I'm renting one out and living in the other. And what we have been talking about consumer behavior is really playing out live in front of me, because this thing had been on the market for 6 months. And right now that interest rates just dropped, we put an offer in on it, and immediately there was another offer too. So we had to compete, right? So like the idea that this had 0 to 2 overnight was very, very eye-opening to me.
Absolutely.
And the other thing that was also eye-opening is something that we talk about here, is like your relationships with your lenders and know how to get this thing to close. Plus this incentive thing is bringing in under market, like the opportunities we're seeing at these like lower interest rates of 5.75%. For me, I don't have the JWB incentive, but am I allowed to share this?
Sure.
You know what I'm talking about?
No, I don't.
I mean, I had been quoted a interest rate of 7.125%.
Oh yeah.
Which is what I locked in a week ago. And I was talking to Gregg about it. He's like, that seems kind of high, man. Why don't I just put you in contact with one of our preferred lenders? And today I got a quote at 6.34%. So saving me 0.8% on my mortgage interest rate. So like, to me, this idea of the consumer behavior that people are going to jump in the moment stuff starts dropping, and B, that you guys understand how to add value to the equation through your network and through this buy down to create this special moment, really made me feel good about the fact that I'm locking this property in right now. Because even if it blips back up, then I'm like, heck yeah, I locked it in right now.
Mm-hmm.
If it keeps going down, I'm gonna be like, great, man. I hope it continues to go down.
Absolutely.
And I just see a moment where like that duplex, the rent right now isn't covering their whole mortgage. But I see a moment, if it continues to go down, I see a moment in 5-10 years where I'm going to refinance. And now that rent will have gone up on the side,
Mm-hmm.
and I now have an even lower rate. And now it's paying for the majority of my mortgage as well, which
Mm-hmm.
is what happens in each one of these properties that I own too.
Absolutely. And you talk about the other effects of being in a growing population metropolitan area like Jacksonville. Not only do you have rates potentially going down in the future, which you will be able to refinance
Mhm.
and drop that expense number for you every month, but you have rents that go up year over year in Jacksonville.
Mhm.
Even during the Great Recession, rents went up in Jacksonville. The rents have never gone down nationally year over year. So you can count on rents going up year over year. And that's why so many people are focused on, when's the right time to get into real estate? When's the right time to get into real estate? Well, there's a reason that I get on the show and I talk about the right time about getting into real estate is
now.
yesterday
Yeah.
or today, right?
Yeah.
And there's always there is always it is such a consistent asset, but it also brings flexibility, which is why it makes so much sense for you to buy and then hold. Because no matter what interest rates do in the future, you're protected.
Yeah.
If they go up in the future, well, great, you're in at a lower interest rate. If they go down in the future, you refinance. But pricing is not something that's flexible.
Yeah.
And over time, rent prices and home prices go up. And so that's why locking in at the interest rate that you can get today, giving yourself flexibility there is a strong strategy, but locking in and buying and holding over a full market cycle is the strategy for success. It's worked for you, me, thousands of JWB clients out there. It'll work for you too.
Yeah. But the key to it is having a partner that you can offload this thing to.
Yes.
That can quarterback this whole thing for you. That's going to be there for 30 years, accountable, right? So that is why we always preach team, because we know the market, right? Like we know that the Jacksonville market is poised to just crush for the next like 10, 15 years with all the trailing, indicators of people moving here, top 10 fastest growing city for the last like 10 years, amazing climate ahead of all the tailwinds of all the stuff. We have this insider info of downtown Jacksonville and whatnot, but the most important part of it is the team, right? Like the idea that this is a vertically integrated company that handles all these stuff. It's like what Denny's saying. This whole story that I just told is a perfect example of the team concept, right? It's like it's not just the asset and it's not like the property management, it's the whole network and the entire experience that you can guarantee, which is that you can provide, which is the reason why I go on a chat with JWB.com just to meet the team, right? Like start so you get on a conversation with the team is huge. Coming to the summit, jwbsummit.com, so you can see it. You can really feel the downtown thing. You can really meet the entire team because we're going to do that whole thing is particularly important. And man, I've never been more pumped. Like from yesterday to today, getting this like new mortgage quote and like really just envisioning this idea of I have now in the last 3 years, now I have 5 properties that I own in Jacksonville, one that I get to live in, and and you guys are handling the rest. Is just I'm so pumped about this market and this moment in time for having purchased personally.
It's amazing, man. I talk about what really motivates me, and it's beyond, selling properties. It's getting access to this asset class for everyday people. Because if more everyday people get access to this asset class, their financial futures are so much more secure. This asset class provides so much stability, consistency, and upside. And so if we can just unlock the access to this asset class, then it can really change people's lives. And it's been wonderful to see how it's changed your life.
Yeah.
Right?
Yeah. Man, it's changed my life. It's changed my marriage. It's changed my wife's attitude towards her job, right? Like her like perspective of like, we don't have kids. So it's like, what are we building towards? And being able to see that with the help of people like Kelly as part of our community as my financial advisor, and like really painting the picture of how all this stuff is affecting our dynamics and where we're going to be in 10 years. Thanks to all this stuff, man. It's really been, it's been incredible, man.
It's awesome, man.
Yeah. It's been really cool.
It's really gratifying, not only to help a client, but to help a best friend.
Stop it. Thanks, buddy.
Yeah, man.
So that being said, we got some questions out here. Let's start with.
Ooh, we got lots of questions. And we got lots of folks here too. Thank you all for being here.
70+ folks. All right, cool. Let's go in a random order.
Okay.
Sanket Gupta says, hello, everyone. Sorry if this was covered earlier. Are the interest rates shown with points?
So yes, all of what we're talking about with points those are costs that would be borne by the client who would be purchasing the property. Every pro forma that we put in front of a client has all of those closing costs. Points are a part of those closing costs. Every client or every pro forma has that laid out. So yes, all the numbers that I'm putting in front of you as far as these interest rates include not just the cost of the down payment, but also the closing costs, also costs on the exit of the asset as well. It's all included there.
And when it's asked, does this include points? I'm assuming it means, does this mean like you're buying points, down, and you're saying that the JWB incentive package is buying the points down for you?
Well, you actually pay points to buy down the rate.
Okay.
So I'm assuming what Sankit is asking is, does this include the costs to be able to acquire this loan?
Mhm.
And points do have to be paid in order to get this type of a loan. But guess who pays the majority of those points to buy the loan down? JWB with the current incentive package that we're offering.
Got it. Okay, cool. Ken Moline has not really on topic, but I want to ask this. This is weird. One online home pricing firm showed one of our properties having a precipitous decline over the past month. Have you seen any data that supports or alternately debunks this home price projection?
Oh man, I'm surprised it's only been one of your properties, Ken. You know, there's a reason that you should not make a decision to buy an asset like real estate based on one of these home pricing aggregators, right? Zillow, Redfin, Trulia, all of them. They're wonderful for helping people get an idea roughly of what costs are, but on an individual asset basis, you can't use it, because I can show you a million examples where they're way high, when they're way low. It just doesn't make a whole lot of sense. Where Zillow and all of the companies like that come in, I think are most valuable is they have really great macro data over an entire market. The best macro data comes from consultants, which, you know, as a supporter and friend of the show, you get all of that secondhand because JWB pays consultants. That's where all this data that I show you is based on consultants that we hire who provide this data. You get the benefit of it because I share it with you. That's the best source. The second best source would be the multiple listing services in your area. Obviously, JWB has access to the multiple listing service in Jacksonville, so that is a great source of data as well. But unless you're a realtor or unless you have a realtor friend, you might not have access to that. And secondarily, or thirdly, tertiarily.
Yeah, that's the guess. That sounds right.
I thought secondarily was better.
No, agree to disagree. Agree to disagree.
If you don't have one or two, then the next best thing for you that's free and easy would be one of these aggregators of values like a Zillow. And I think there's more value there when you're looking macro, like search your local area, like the Jacksonville market. I've seen it be relatively good. I've shared some of the data on the show, so I thought it was good enough to share with all of you. But on an individual asset, don't get too excited if that number is spot on, is high, or is low. It's just not something that can be trusted due to the limitations of the data at this point.
Yep, got it. And I'm not surprised that I get offers for my homes all the time. I'm sure someone's out there saying, "Hey man, this thing's dropping. Don't you want to get rid of it?" You know, like it's probably just marketing stuff, man. So that being said, a couple more questions here. We got a couple people that are wanting us to go deeper into the incentive. So Sankit and Marty are both saying, Sankit's asking, is the incentive still on? And Marty is asking, can you go over the incentive program in place for a limited time? Do you have to buy 3 houses in order to get that 5K per house?
Marty, I'm glad you asked that question, because there are actually multiple incentives that are going on right now. So the incentive that I've been speaking about is strictly about an incentive to help you achieve the lowest interest rate. And so that's where JWB buys down the interest rate for a client. And the incentive comes out to about $5,000 per property purchased. It's actually 2% of the sales price. So I'm just estimating there. So call it around $5,000. Now, for that incentive, you do not have to purchase multiple homes. You can purchase one home, and JWB is still offering that incentive. And that can be received by you in one of two ways. You can decide to say, hey, you know what, JWB, you don't have to buy the rate down for me, but just give me that money at closing. And that roughly $5,000 would come to you, and it would reduce your out-of-pocket expenses at closing. Or you can say, well, JWB, yeah, let's get that interest rate, the lowest interest rate we can get. Go ahead and buy the rate down for me. You don't get that $5,000 at closing, but your interest rate is lower. And 5.75 is very accurate for what the market is bearing, assuming the interest rate is bought down. So that's the first incentive. And that's the one that will be going away at some point. When interest rates get low enough, at some point, we're going to go away with that one. In addition to that one, this is an incentive that we just haven't talked about in a while, but for our clients that make a decision to purchase multiple homes at one time, to purchase 3 homes at one time or more, we also have a multi-purchase.
Bundles, baby.
Thank you so much. I was about to ccall it a
People
multi-purchase.
that purchase bundles.
Bundles.
Yeah.
It's like the MVB, right? Patrick Mahomes. He's the most valuable bundler.
Yeah. Mahomes Motto.
Oh man. So if you want to be an MVB, then you can be a most valuable bundler. And yeah, so if you purchase 3 homes or more at one time, we give you an incentive for that. And that incentive is really large. It's $5,000 per home. So I was helping a friend out with his portfolio not too long ago. He decided to purchase 7 homes. So 7 times $5,000, he was able to walk away with a $35,000 check at closing, which actually reduces that out of pocket for him. So there is no limit to that. So no upward limit. The bottom limit is 3. You have to purchase at least 3 at one time. You can combine these incentives, which is what my friend did as well. So again, this is a really special time for you to look at purchasing properties between all of the macro trends that we've been talking about with the interest rates, between what we're talking about here as far as JWB incentives. Like this is a moment to pay attention and do something about it.
I'm not gonna lie, GC. As a marketer, I feel like it's been a while since it's been like this moment of like,
I know, right? Like there's no longer are we like fighting this like burden of interest rates as much as we were.
Yeah.
Goodness.
Oh my God, it makes the job so much easier.
Yeah.
All right. So real quick, 2 different incentives. One is the bundler incentive, which is what?
$5,000 per property.
$5,000
minimum of 3 properties purchased at one time.
And then there is the limited time incentive to buy down your rate, which is what?
Which is roughly a $5,000 contribution to you, either in the form of cash at closing or buying down your interest rate. That $5,000 is used to buy down the lowest interest rate.
And if you buy a bundle and bundle the offers,
sure, like
you're rich. You're just rich.
I don't know. You're just I don't even know what to say.
Printing money. All right, cool. Jenny Berger's got a couple of interesting comments. First, she says she loves third Condare. LOL.
Thank you for your contribution, Jenny.
Yeah. She's also asking, do you have a lender that we could work with on a refi or non-JWB property, or are these rates only for new purchases with JWB?
Absolutely. Happy to refer our network of lenders to you. So Jenny, I think you're a current client, Jenny. So just reach out to your JWB portfolio manager, or just send an email to info@JWB Companies. We're happy to be helping you. Happy to be helping you out.
Happy helping. All right, cool. Sounds good. Thanks, Jenny. Eddie Harris from Atlanta says, if you have properties in a retirement account and can pay the entire balance off, does it make fiscal sense to do so and save on the interest, which is higher being non-recourse loan? Thank you. You guys are awesome. You're awesome, Eddie.
You are awesome, Eddie. You know, as you would probably expect, being an avid listener of the show, Eddie, you know, this is one that we got to talk about what's best for you. So many things go into it. So I would highly encourage you to jump on the phone with my team and have that conversation. You know, generally speaking, without getting into your specifics, you got to look at it's a 2-part answer for me. So what is your alternative when it comes to putting your money into something? What are your alternatives? And, you know, what is the best risk-adjusted return there? And then what's your lifestyle?
Yeah. What are your goals?
Yeah. What are your goals? Right. So I could give you an answer where you would have a better risk-adjusted return on investment, earn a higher return, but it might not be the right answer for you because that might not be the place of life that you're at right now. So I think we need to talk. And that's one of the things that we love to do, is be able to help people say, well, should you buy this all cash in your retirement account, or should we take out a loan in your retirement account so that you can buy more assets in your retirement account? And instead of maybe 1 property, maybe that's 2 properties or 3 properties. So would love to have that conversation with you, Eddie. And yeah, just reach out.
All right. We have a couple of social announcements from the fairy godmother of the Not Your Average Investor Show community, Jen Filzen. I'm sure you've heard of her.
I am aware.
Everybody knows Jen Filzen. She's saying, reminder for those Northern Californians who can't go to the JWB Jacksonville meetup, we are having a little by the way, if you can go to that both. You can double 100%. Up if you want and get on the inside of the cool club before you come to Jacksonville. But we are having a little gathering at our apartment in Monterey on Sunday, January 28th, 2024, planning a fun day that starts at noon and involves food, friends, and fun activity on Canary Row. For details, contact me at 408-833-9868 or jenniferfilzen@gmail.com. Everyone is welcome. So if you or a friend want to join, please do. Jen's a fun time. Highly recommend. 5 stars.
You know what? And if we think of it, she absolutely is a fun time. You will have a blast if you can make it there. But I just want to say a special thank you to Jen and to Renee, her husband. If you think about how far collectively we've come as a community, none of this would be possible without Jen and Renee.
Yeah, true.
And the love and the warmth that they show by opening up their home to friends, to new friends. They don't even know some of you all yet, but they're opening up their home to you is incredible. It shows the quality of the people that we have in our network. And Jen has been the biggest advocate for our kind of informal meetups from the very beginning. She's hosted many of them, and that has spawned other meetups in different parts of the country. But it all started with Jen and her being such just a integral part of what we like to call the Not Your Average Investor Show. So thank you, Jen. I hope you all take her up on that opportunity. And that really is the genesis of the summit.
The genesis.
Oh gosh, between MVB and the genesis today, we're on a roll, brother.
Yeah.
So thank you, Jen. We love you.
Yeah, love it, Jen. And if you don't know Jen, I guarantee you, she wants to know you.
Oh, and you will know her.
Ever. That's why we call her the fairy godmother, folks. All right, let's go to a couple more questions here. Linda Allen, Solo K investments seem to have a higher interest rate than normal 30-year fixed loans. Are they dropping to this rate as well?
Yeah, so I think what Linda is talking about is lending in a retirement account, and a solo 401k is a type of retirement account vehicles. And lending to any type of retirement account is completely different than what we'll call conventional lending. Conventional lending would be like lending to Pablo as an individual. Pablo is getting a loan for the duplex that he's purchasing with his lovely wife, and he's going to get a loan in his personal name. This is not Pablo, the retirement account. Pablo, the retirement account is somewhere else, okay? It is a different entity than Pablo, the individual. And when Pablo, the retirement account, is buying a property and getting a loan, it's a completely different scenario. So at the back end of it, there's a lot more risk to the lender because of that. And so ultimately your rates for any retirement account that you're purchasing properties in, your interest rate is going to be a lot higher than what I'm sharing here. So happy to go through the pros and cons of taking out a loan in your retirement account with you. We can do it maybe on a future show if you guys let us know. If you have show ideas, let us know. We always throw them in there. But what I would really recommend is just jumping on the phone with my team, because we know all about non-recourse loans. And a non-recourse loan is what you would need in order to get a loan for a property in a solo 401k.
There you go. All right, we got a couple more here. Pamela Myers. We bought our first JWB property last year and want to purchase another this year. Awesome. However, we are self-employed and practically have to give a kidney and our firstborn to get approved for a loan.
Yeah.
Familiar with it. Despite our great credit and financial situation, it is always difficult to go through the loan process. Again, does JWB offer private financing? I thought I heard something about this on a prior show.
I feel you on how difficult it is to be a self-employed individual as an entrepreneur and to get a loan in today's lending world. It is a common annoyance and agony for our clients who are self-employed. It's just harder to do all the hoops that you have to jump through. So I feel you there. To your question, does JWB offer private financing? Answer is no. It wouldn't be in your best interest even if JWB did offer private financing, because your interest rates are not going to be nearly as low as what you can get from conventional financing. And it's not even close. And that's why I know how painful it is to go through the conventional loan process. But it's worth it when you buy and you hold this asset. So JWB, we are not a lender. That is not our business model. We are somebody who borrows money and then we make investments. We don't lend money to individuals. So can't help you on the private side. I will tell you that we have a wonderful team of lenders. Our network of lenders is who, Pamela, I'm sure you worked with our network before, and not every lender is built to be able to do loans for our entrepreneurs. And sometimes your situation changes and one lender might be able to help you a little bit more than another. So if you haven't had that conversation with our team and talked about which lender is right for you, I would encourage that, Pamela. But at the end of the day, just know that it's a pain in the butt, but it's worth it if you can get that conventional loan.
Also helps that you got a great quarterback during the closing process here at JWB, right? I mean, Pamela's already a client, so He knows, right?
Yep.
But I don't know if you wanted to touch on that for anybody listening.
Yeah, and Pamela knows, she's been through it, and our clients know, but the loan process in general, even if you're not an entrepreneur, even if you're not self-employed, it's not fun. And that's a good thing for the overall economy, that it's not easy, but you need a quarterback, you need an advocate for you going through that process. And that's a part of the service that we offer. It's a part of our vertically integrated approach. You have a teammate at JWB who's going to be helping you all along the process. And JWB sells hundreds of investment properties a year. And those loans, that network that we work with, they all report to this individual in our office who helps quarterback for our clients. And so it's good to know that you're not just one property, or one of hundreds and hundreds and hundreds of properties that are sold by JWB, that are loans to all of our lenders in JWB, to know that you have the power behind you to make sure that things go your way.
Awesome. Sanket's got another question asking, sorry, one more request. No apology needed. This is why we do this thing. It would be great if JWB can do a periodic comparative analysis for our properties.
Ooh, are you thinking what I'm
thinking?
thinking?
What I'm thinking. Sankett, you want to come on the show? We'll do it live.
How about that? Let's do it.
Yeah, Sankett, I'm going to have Cody reach out to you, because we love to do like an investor spotlight. We show you all this stuff. Gregg goes even deeper than like your regular reporting, and we'll reveal a bunch of things as the guest investor of the week.
Absolutely. And let me just add one thing. If you're not like Sankett and you're not going to come on the show, we've got you covered as well. So JWB's reporting on a monthly basis compares your return on investment. It provides all that analysis for you. And it's something that's a part of our everyday service. And we have the portfolio manager to be able to help you understand exactly how your numbers are working and your returns are being generated. So if you haven't seen the client ROI report, which is offered to every client, if it's included, reach out to your portfolio manager, set up a call. I'll be happy to walk you through all that.
Got it. A couple more questions, but I did say that it was 2 social announcements from fairy godmother / the Genesis, Jen Filson. Regarding the summit, please remind everybody that Lee Bishop, Bill Shields, and I, meaning Jen, Isis, are all hosting social time together, including a karaoke party at the Shields home on Saturday evening after all the festivities, February 17th. Once the event is done, lots of fun to look forward to with the Not Your Average Investor Show community. Are you going to sing karaoke?
That is going to be rocking.
Yeah.
That's going to be rocking.
You know that Jen was like a Grammy nominated recording artist.
I feel like I knew that, but I don't know if I've ever seen her sing karaoke.
So Jen's got some pipes, and I have a ton of energy. I promise you, that you will not be impressed by my singing, but you'll be impressed by my karaoke performance. And I'm sure we'll be impressed by the Shields' hospitality. And I'm pretty sure Lee's got something up his sleeve.
Oh man, this is gonna be a great event.
It's gonna be a good time. All right, so that's for Saturday night after stuff is done. Karaoke, baby. Last 2 questions. Anonymous attendee.
Ooh.
What is better to own, houses or invest capital in commercial, and why?
Great question. It depends.
Mhm.
That's a common answer that you'll see when it comes to specific questions on your portfolio. And that's because there's 2 sides to the equation. There's the risk-adjusted return side of the equation, which I can go through some of the pros and cons with you, but then there's the lifestyle part of the equation. And if you kind of look at both of those to make the best decision for you, that's how you'll end up being really successful. And that's one thing that we love to do and sit down and map that out for you. Specifically on commercial versus single family rental properties, not a lot of people know this and think through this. I think many people just think, oh, wow, I'm just going to use single family rental properties as a stepping stone to get to commercial. There's a whole lot of risks that come along with commercial that are just not there on the single family rental property side. Like, for example, if interest rates go up the fastest that they ever have in the last 40 years, the effect on the value of the asset of a commercial property is much more drastic than the effect on the market value, the asset value of a single family rental property.
Explain that.
Because single family rental properties are valued based on what the next person around you pays for their house. And the next person around you in your neighborhood, those comparable sales, are not based on a return on investment. They're based on how much that family wanted to move into that house, largely.
Correct.
Which is not nearly tied to return on investment. And so as interest rates have gone way up for single family rental properties, like every other asset, what have home prices done this year, Pablo?
They've gone up.
They've gone up slightly,
Yeah.
right? Well, you can't say the same thing in different aspects of commercial, especially commercial office. right? Commercial office, there's a whole lot of risks there. One of them is interest rate risk, because as interest rates go up, the income stream of that asset goes down, which means the value of that asset goes down to the investor. So there's more interest rate risk for commercial apartments, anything that is valued on an income approach and a return on investment approach. There's more interest rate risk. You're safe from that on the single family rental property side because of the way it's valued, which is not valued based on a return on investment for all other places other than JWB. We live in this wonderful world where we see it for what it is, as an investment, and we're able to capitalize on that. But we all know the rest of the world makes decisions on single family housing based on emotions, right? And all that. So we haven't done a whole lot of digging into that, but that's a really, really important nugget. And one reason why I think many people are quick to jump to the next asset after they figure out single family rental properties, but I don't get it. Those people who jump from single family rental properties to commercial office they're not feeling too good right now.
Yeah, true. All right. Final comment here from Mike Foster. Mike, good to hear from you, man. Just a comment. In earlier home purchase examples you've shown us over the months, you used 20 to 25% down payments. Several months ago, it was 30% down. More recently, including today, the example includes 40% down. I know that higher amounts allows cash flow, but major benefit of lower down payments like 20 to 25% is the ability either to keep more cash in hand or it may allow an investor to purchase an additional property.
Great point, Mike. You're spot on. If you've been following the show for years and years and years, like Mike, you've seen that estimates used to be using 25% down, let's say 3 years ago. Whenever I would provide these pro formas and these analyses, I would largely use 25% down. That's when interest rates were low force, right? Then as interest rates went up and home prices went up, if you still put 25% down, but your interest rate was 6.75%, well, you're going to produce a negative cash flow situation. And so the vast majority of our clients, we're going to put a situation together for you, which is going to be positive cash flow. And the way to do that, even in an environment where interest rates are rising and home prices are rising, is that you'll need to put more down. So ultimately, Mike, you're 100% spot on. The reason that I'm choosing 40% down as the examples is because the vast majority of clients want to be positive cash flow in their investments year one. And by putting 40% down right now, you guarantee, well, I won't say guarantee, your estimated cash flow in year one is positive. I could get a little cuter and maybe put 35% down, especially as interest rates have come down potentially, but I've just kind of standardized it around 40% for the last, year or so, six months or so. And that's really the reason behind it.
Got it. Good explanation, buddy. I can't wait to see everybody February 16th, 17th. Like, I just feel this like surge of kind of like good vibes that keep on happening. The chat keeps getting better and better. We're getting new friends joining us here on the show. Just really, really fun. Oh, are there investors in Minnesota? Michelle, you know what? I think it's a Lita Song who is also in Minnesota.
Good pull.
She joins us on the show often. So yeah, there are investors in Minnesota, Michelle.
That's awesome. And did we have our, was Michelle the one from Minnesota earlier?
I believe so.
Yeah.
Or somebody else.
There might have been somebody else in the chat.
Yeah, there was somebody else in the chat. So yeah, there's definitely folks from Minnesota. Keep coming back. By the way, join our Facebook group, the JWBFacebookgroup.com. Will take you straight into our Not Your Average Investor Facebook group. Bunch of people in there talking, being friends, kind of like they do here on the chat.
Yeah, and I just want to talk about filling up for the summit. We did not expect, just by talking about it on the show, that we'd have 45 folks signed up for tickets.
Signed up.
All right. Last year, I think we had 53 people. And that was after we actually started to market the thing, which we are going to start marketing the thing next week. And so, fully expecting this to sell out. In fact, talking about adding buses to make sure that we can accommodate. So I would highly encourage, if you're thinking about joining us, please do. We would love to meet you, and you got to do it quick. So go to jwbsummit.com. The price is $139 after January 14th. Go ahead, go there now, put in the promo code NYAIS99, and then you can sign up for $99. And let's have a party. It's going to be a ton of fun, and we can't wait to meet you in person.
It is. I'm keeping scrolling through here to look for that Minnesota comment over here. But anyways, it's going to be a ton of fun, man. I want to thank the community for showing up today. Man, we don't take it lightly that you take an hour of your day to just hang out with us on a Thursday or a Tuesday.
Amazing.
It is not a small ask. You come in droves. You had 70 plus people here today. Really, really filling our buckets.
Look at all these hearts and
lights
thumbs up and
claps.
handshakes. It's amazing.
Really
Thank
cool.
you guys.
It's really cool. Thank you guys so much.
I feel like a little schoolgirl here. I talked to my daughter and she's like, Dad, look at this emoji. And I'm like, I'm seeing all these emojis and hearts. And I'm like, man, I feel the love. It's great.
I did too. I don't remember what the theme of the show is on Tuesday. It's going to be awesome. But really, just from now till then, if there's one thing that I please implore you is to
don't be average.
See you on Tuesday, fam.